Hey everybody, it's Brian Shannon from AlphaTrends.net. Today is Friday, the 23rd of October, and what can you say but wow? I mean, just an amazing move in the market this last week and this month. Let's take a look at the numbers here. The S&P 500 finished with a gain of 2% this week, up 8.2% month to date, and brings it back to positive year to date. And the Nasdaq up 4% for the week, 10.5% year to date. Just some crazy big numbers here, and you can thank your short sellers for this because there's a lot of short sellers who've been stuck and stubbornly fighting this market as it's been rising the last 2 weeks. And we talk all the time, and I was very clear about it last week about potential levels of resistance. We identified this band of prior support. We identified the 200-day moving average. We identified the year-to-date volume-weighted average price and made it very clear that these are potential levels of resistance. Nobody knows where resistance will be until after the fact. Until it gets up to a level and turns back lower, it's just an area to be aware of. If you were shorting into this area because you thought it would be resistance, you learned a pretty expensive lesson. Let's take a look at the intraday action on a 30-minute time frame. I've been talking about the fact that we remain cautious because of the declining 200-day moving average, because of the declining 50-day moving average, that they typically do not do this. Typical does not mean it doesn't happen. And here's a great reminder of why defense is your strongest position. The 5-day moving average continued to rise. We dipped below it briefly this week, and let's take a look at a 10-minute time frame to show that. We dipped below it briefly here, but we held above this prior little band of resistance. And as I told subscribers throughout the week to Alpha Trends, if you're going to trade short, you do it for a day trade only because we have a rising 5-day moving average. When the 5-day moving average is rising, we do not short for anything more than a day trade. If the market had done something like this, and this is kind of actually what I thought would happen, I said, let's be on the alert for something like this to happen, then we can get short. But instead, the market rallied up. So again, I'll repeat the phrase, it's better to be on the sidelines in cash than it is to be in and wishing you were out. The people who are in and shorting at this perceived level of resistance sure wish they were out on Thursday, and they figured, well, there's no way the market is up too much. There's no way it can continue because we have all these important levels of moving averages, prior support, volume weighted average price levels. They figured there's no way this can hold, and then they just got crushed here again today. So the market is obviously extended at this point, but extended doesn't mean it can't continue to move higher. There's no such thing as up too much if there's more buyers that come out of the woodwork. So we have to look at levels and respect the levels and be aware that, as long as we have higher highs and higher lows, daily R2, good level to be aware of, but it doesn't mean sell short unless you are a day trader. So for instance, selling short in your daily R2 as it breaks back below VWAP, it seemed like a reasonable fade today, but as it gets back above VWAP and reverses those lower highs and lower lows, so we're looking at a 1-minute chart for those of you who might not be familiar, as it gets back above there, there's no reason to continue to hold on the short side, even for the aggressive day trades. So, going into next week, we're still in a position where, we have this market, we've been down over 10%, we've been up a couple percent this year, and here we are year to date in the S&P 500 up less than 1% at this point, but we've seen a tremendous amount of volatility. And I'm going to point out again, this is why I'm a trader. This is why I respect the trend based on what I consider the most important trend is the 5-day moving average, and I consider that the intermediate term trend. It's easy to get sucked in and think, hey, it's up too much, but when you have a pattern of higher highs and higher lows and that 5-day moving average is rising, it's best to stand clear and not get involved. Just as you may think it's down too much, you don't want to be a buyer while the 5-day moving average is declining. As the market moving average flattens out and we get a higher high, then you want to be involved. And then you want to be involved on the short side if we see, when we see the 5-day moving average flatten out and we have lower highs and lower lows below it, and then we set our stops and manage risk. That's our number one job, is to manage risk. The Nasdaq has only closed higher than this level 3 days this year. There's only been 3 days where it's closed higher than where it is today, which is just crazy to think about considering where we were on August 24th and the panic that was down there and all the negative sentiment and emotion. Our year-to-date volume weighted average price, we were thinking maybe it would pull back to that level this week, but it just continued to ramp higher. So here on a 10-minute chart, you can see we briefly, when we spoke about in last weekend's video, this being the key level of support, that as long as it holds above that, you don't want to be short, especially with the rising 5-day moving average. And the shorts, learned an expensive lesson. And here we are, well above that 200-day moving average now, when just 4 days ago, it looked like we were battling it, 107 and change. Now we're, 3-4% above it. The Russell 2000 was clearly the underperformer and has been the underperformer year to date, down 3.1%. Month to date, only up 6%, and really lagged this week in particular. But let's take a look at the action here. We've seen that, and we spoke about the possibility of an inverted head and shoulders pattern setting up in here. And we've still, we broke this downtrend line and we're still kind of fighting with it, but the 50-day moving average is starting to flatten out a bit. We've clearly got a very important level that is resistance right now. It has been resistance over the last 2 weeks. So it will be very important that if the Russell 2000 is going to start to catch up to the rest of this market, we would, the ideal scenario would be it would break beyond that level, come back and test it and hold as support or dip slightly down, and then be able to rally back up. Speaking of this Russell 2000, it's really kind of similar to what we had seen last year, that is in 2014. We saw the market break down. It looked like it had the possibility of doing something like this. And I made it very clear that from failed moves often come fast moves. That's actually quite possible that this is what might be setting up in the S&P 500. It's still too early to say, and we're quite extended there, but it's something to kind of a little nugget to squirrel away. Back to this Russell 2000 on the 30-minute time frame. Here's what's been at resistance the last couple weeks, and if we break above and beyond that, then you have to say for your time frame, which one of these higher lows is the most important higher low for you to set your stop under. Are you going to give it a wide berth down to 112.5 or maybe 113.5, or perhaps if you're even more aggressive, 114.75, or if you're going to look at it from a shorter term time frame, I guess that would be about it right there at about 114.70-ish. So looking at the Russell 2000, you think, well, it has the possibility of being able to play a little catch up to the rest of the market and maybe making a run for the 119 level. Keep an open mind. Don't be so, you don't have to be bullish or bearish. You don't have to call it a bull market or a bear market. I truthfully, at this point on the S&P 500, I don't know if we're in a bull market or a bear market anymore. We're in a bullish environment. And just as I said, 3-4 weeks ago in this area, we're in a bearish environment. Well, the bearish environment turned back into a bullish environment. We could take a look actually in here and say from point A, let's just call this 183 up to let's call that 203 just to keep the math simple, 20 points. We add 20 points to this pullback low of 187. Now we've hit our measured move objective. So is this now going to be the resistance? Well, there's zero evidence that it is resistance. It's another potential level to be aware of. That's all it is. So again, be aware of the levels. Do what's right for you in your time frame and manage risk. The semiconductors we've been pointing to, saying that the way that they behaved and the fact that they broke this resistance, the 50-day moving average flattened out, and that resistance turned into support, the market rallied from there, that this could have been the leading indicator for the Nasdaq, which in fact it obviously has. So the semiconductors continue to be the leader in here, and they are just continue to ratchet up these gains. They're sucking in short sellers on these quick breaks below the advancing 5-day moving average, or the test of the advancing 5-day moving average. But we still see a very clear pattern in here that is higher lows and higher highs. that is the definition of an uptrend. If we pull back down to 55, there's a nice little short-term trade in it, but it's done nothing to damage the intermediate-term trend if we pull back there. So the question is, where has it come from? Where does it have the potential to go? Are you comfortable buying up in here for anything more than a day trade? I'm certainly not, but do what you feel is right for you. The biotechs continue to underperform a little bit. It is good to see that they are, stabilizing in here at least. And on the 30-minute time frame, we've got this prior, what's been resistance in here recently at this prior little support. That this is now currently our band of resistance. Will it in fact become resistance again? I'm not going to predict that. I'm not going to be the dope that sells short there. And I don't mean that anyone who sells short there is a dope, but for me, in my way of viewing at the market, it's not the way I look at it. So if it ran up to there and pulled back, perhaps there's a short. I think the ideal scenario would run up to there, pull back, create a higher low, and then break beyond, and maybe these biotechs can continue to or start to rather catch up a little bit. But you look at the risk in this group with stocks like VRX just completely getting smashed, and biotechs are risky stocks. When a stock goes from $260 down below 100 in just 2 months, or ENTA was another one this week. I mean, the stock was halted 6 times, I think, on Thursday, dropping from 40, getting cut in half in one single day. It's a risky group. Let's talk about Apple for a minute, because Apple clearly broke the downtrend line, broke this resistance here at 113. As I said, it's Stocktoberfest. If it gets above 113, in my mind, it doesn't make it bullish. It turns it more neutral. Now, these guys have earnings after the close on Tuesday. I think, the best scenario in here would be for it to pull back down into this level and then have a good reaction to earnings. And then I think we could see the stock rally back up towards 125. The quality stocks that are in uptrends are continuing to outperform on the upside. Earnings report. Look at how Amazon reacts with earnings reports. Facebook up at an all-time high. Shares of Netflix underperformed a little bit, but that was after their earnings report. So that one's going to have to consolidate a little bit. Then you get stuff like Twitter, which is still, in the garbage, and you get stuff like Walmart, which supposedly is a good company. They sell stuff cheap in their stores, whatever. But Walmart, the stock, is a stock to continue to avoid. It's in a downtrend. Buy the stuff that's advancing, have a strategy, stick to it, know your time frame, and that's how you get consistent results in the market. Thanks for tuning in. I'll talk to you next week.